Dan, we had a whole nice plan for you on something very different, but we're going to start with big tech.
I prepared for the plan.
Right,
all screwed up now.
We love ripping up plans. What do you make of the rally that we've seen today in big tech? Like, how much of that was an oversold thing? Is it a buy the dip mentality? Is it product driven? What do you make of it?
I think it's a mixture of everything, although it is hard to argue that there's an oversold condition in big tech. I mean,
on a relative basis.
Other than Apple, and Tesla is obviously its own thing, but other than Apple, there hasn't really been very much weakness in those names, and justifiably so, because fundamentally, the companies are operating quite well, and while there's obviously a bit of a risk-off tone to the market, at least yesterday, the product cycle is what's been driving NVIDIA. The product cycle is hopefully what's going to be driving Apple and what's been driving Microsoft. It's not flows, because ultimately they all benefit from the passive flows, which have been coming into the market more or less unabated over the last couple of years.
Are you surprised that we're almost near 5% on the 2-year, and yet stocks were doing nothing? They're higher?
Well, yes and no, because I think ultimately the level of rates right now doesn't really matter. The adjustment period matters, and I think to that point, sure. I was joking with someone, an investor earlier in our fund, that we should be printing up shirts. I survived. Again, we should be printing up shirts. I survived the great crash of 2024 because it was obviously a full percent. That's about all you get these days. Do I think that 5%?
We'll do that as soon as we get finished printing up our earthquake shirts.
As long as I get my royalty fee. Do I think that 5% is some deleterious level for stocks? No.
Yeah.
Do I think that's true for the 10-year? No. But if you have a rapid adjustment, as you saw yesterday, then it will be a problem in the short term.
There's been a lot of discussion, though, that we've kind of in this sort of weird sweet spot, kind of inadvertently, if you will. The idea that the market has shown that resiliency as rates went up. It's shown that resiliency as rates have remained elevated. And unless you believe that rates are going to somehow shoot up to 5.5%, 6% here, is there any reason to think why we can't see more gains in this market?
No, because I think I said this last time I was on air with you guys. It's almost as if rates don't matter nearly as much as some people thought they did. And to be clear, rates matter, both what the Federal Reserve does and Treasury yields. I don't mean to suggest too flippantly otherwise. But I think when you have a tailwind where the economy is doing pretty healthy, I think we need to stop saying it's surprise to the upside. The economy is doing well, full stop, even with rates where they are. And earnings growth is doing more or less fine, even with yields where they are. This idea that somehow if the Fed only cuts 2 times this year or only cuts 1 time this year, that's some catastrophe for the market, I don't think that's borne out, especially by the performance in the first quarter.
Everyone we've talked to over the last few weeks have basically said that the earnings picture is going to be a lot more important for where this market goes next rather than just what the Fed does. But a big component of that was this idea that we were going to start to see a broadening of earnings growth beyond just the big tech and some of the big, more established names, and for that matter, a broadening of what people buy. Has any of that changed over the last couple of weeks or months?
It depends how you look at it. On the earnings front, no. I think most viewers probably know, and I'm sure you guys are aware, earnings at the big tech companies are expected to be up 30 whatever percent, and everyone else, the 490 whatever, are going to be down a few percentage points. So on that front, it's a little more challenged. But I think that's too broad of an observation, because when you look at the performance of a number of industries and sectors, for a while, it was just semis and home builders you would point to. But I think something I've been harping on for the better part of a year now, and I think it's a little more well understood, is what's been going on in the industrial space. It's not just your traditional industrials, I call it Caterpillar. It's the names that are data center adjacent, if you will. They're building out the data center. They're cooling the data center. They're building the roads to the data center. There's something going on there as well. The hotel and leisure stocks and those. There's plenty of themes to play beyond simply AI. And so on that front, while I acknowledge the earnings story is a little more challenged, on the performance and the fundamental front, I think there's a lot going on that's very interesting, if not more so than the AI story.